companies, right? So companies that are around, that are generating revenue, that have a lot of customers, and we're trying to kind of take them to the next level, but it's a very different approach to investing and also the type of manager you're dealing with.
The way to think about it is, again, I'm sorry, I'm running the
No, go ahead.
down. So when you are raising, when you raise a mortgage, when you have leverage from the banks, you need to make interest payments. If you don't make interest payments and don't make regular principal payments, you will go bankrupt, right? So the company should have the capability to generate the cash to make the interest and the principal payments. Venture capital companies mostly don't raise debt, and the companies don't have the capability. They sometimes don't even have the revenue to generate the cash to pay the interest payments. Private equity, you need to make interest payments, you need to make principal payments, you need to have cash.
Yeah, the other quick thing I'll say is, usually in VCs you're giving them money because they need money to grow, to get off the ground, right? So they're coming to you, it's a founder coming to you because he or she can't do what they want to do with the capital they have. Whereas in a lot of terms of private equity, you're just buying somebody else's stake. There are times you'll give money to businesses just to grow, whether it's an acquisition, but most of the time you're just buying someone else out. So it's a little bit of a different type of investment.
There is a middle ground, and people call it growth equity. Kind of
two questions. For venture capital, when like a firm is injecting capital into like a growth company, is it all equity or is it like debt involved also? Like is it leverage like private equity?
not all equity.
So it is usually all equity, but now there's a recent version. They call it convertible debt. So if you approach a VC, they will give you the money, but they will not structure it as equity. Because when you structure it as equity, you need to say what is the valuation of the company. But when you structure it as a convertible debt, you don't need to go into the discussions of, what is the valuation of the company. This is just a loan on the company. And then when the company becomes like valuable later on, then you can convert it into equity and think about valuation at a later stage.
Okay,
But it's mostly equity. Just think about it as equity.
And that's the reason why there's like no interest payments.
Yeah, exactly. For venture capital, yeah. Because
Very.
And like second question, with private equity, like when you guys like buy out like firms and whatnot, like is it just like private firms, or is there can be like public firms that are in distress, or what's the deal with that? Because like I don't know the process from making a firm like public, you buy it out, and it's like private.
So I can probably talk to that. We looked at, and it depends on, a lot of things depends on investment size, so how much money you're looking to put into the investment, which is how big your fund is. We looked at a lot of public companies, mostly probably due to size, and it's a little different process because there's already a price on the company, right? There's a lot more confidential information going because people are trading on it in and out. And really, the way you just do it is, there are a bunch of different ways to organize the agreements, but you're essentially buying out all the public shareholders. It's a very similar process to doing it on the private side. I mean, you're still getting debt, you're still putting in a decent amount of equity. It's just a little more touch and go because they're public companies and public company CEOs and lawsuits, etc., as opposed to buying out a founder.
Like when you buy out all the shareholders, don't they have like an option to buy back though? Like how do you make it a private company? Is that like a legal thing or?
There's certain regulations within the companies. If you get X amount of the shareholders to agree to sell their shares, you can squeeze out. So I think it's like 90%. If you get 90% vote, you can kind of squeeze out and force the other 10% to sell. I think a couple years ago, people were allowing people to roll their equity, which is very uncommon. But most of the time, you're buying out everybody, and you're taking, there are a lot of times there are CEOs or someone that had a large stake in the company. Usually, you might want them to stick around, give them options or something, and keep them involved. But you're taking it private. It's not trading public anymore.
And you mentioned the distress side as well. I mean, depending on what your firm's focus is, you can always go bid on a distressed company coming out of restructuring. Usually it's some of the smaller middle market guys or guys with that particular focus, because I think it is a very different world than, buying larger public and private companies and just managing them. But there are people who focus on that specifically.
And like after a buyout, the company won't be listed anymore.
Right. No. Can't be traded, and you own everything. So, and the advantage to that, and at least what we used to kind of pitch to managers, and what they would say to us is, they don't have to do calls with analysts anymore. So, they'd have 20 analysts covering them, and they'd have to have an earnings call every quarter, and then analysts would be calling them, investors would be calling them all the time, and that's all gone. I mean, there's nobody left, and that's a big, in our view, that was a big weight off the shoulders of the management. They could focus more on the business, and I think The other advantage is we would buy a couple of companies that we wanted to make a big transformation, whether making this acquisition that may not look so good for the first couple of quarters, or changing the sales force structure. And if you're in the public markets, I mean, you have to worry about your stock price going up and down. And I think in the private markets where maybe there's a 5-year hold, you don't have to worry about volatility every quarter. You can take a much more longer-term view, and that's kind of the advantage of taking companies from public to private.
You free yourself of those short-term expectations, which really
Yeah.
gives the management more room to kind of pursue the best strategic initiatives for the long run. Although keep in mind, private equity is also 3 to 5 years, but that's a lot longer than quarter to quarter. And then one other smaller benefit is there's a lot of costs that are associated with being a public company, from auditing to compliance issues and a variety of costs that are immediately stripped out of the business the second you take it private. Depending on the size, I mean, it can be substantial or not.
Your finance professors will debate very much the value of buying a company that's already public. Whether you contribute anything beyond leverage. And I think that whether you contribute anything beyond like putting debt on the business, and it's an ongoing public debate, and good private equity firms generally can add value by owning a company, but many may not be able to.
Like
Yeah.
value, like by operations.
Like change it, yeah, like by sitting on board and like having good ideas.
You'll be surprised, but there are large companies where there's just rampant mismanagement. And if you just have the discipline as a professional to go in there and stop that, I mean, you can create real value. Yet alone, like getting in and actually tweaking operations and things. But there's usually some low-hanging fruit in these businesses that you can go ahead and take advantage of.
It's not every business.
But it is a good debate, because a lot of times, at least if we were taking companies from public to private, most of the time, not all the time, when we exited, we were taking them public, just due to the size. I mean, some of these larger deals, which none of us were involved with, these $20 billion LBOs, you can't sell that company to anybody, it's too large. So you're taking it private, you're taking it public again, you're hoping that you just added value in between, or took advantage of a mispricing in the market at that point in time.
Can you let us know a bit why you chose to go into private equity, and like when you were thinking about leaving your banking or consulting job, why you didn't choose to go to hedge fund, because both are similar in that they're about
Should we go to Emily?
Anyone, sir?
Yeah, well, I was in leverage finance, which is a group inside an investment bank that helps private equity firms raise debt so they can do these buyouts. So I had a lot of interaction with private equity firms when I was at Deutsche Bank, and I really liked what they did. It seemed pretty cool. They got to go fly around private jets and meet management teams, and they seemed really smart when they called to yell at me to do a flip book better. So I thought, well, it would be awesome if I could be like these guys. So that's kind of really why I went into that side. These guys seem cool, they seem smart, it sounds like a cool job. And I really didn't know that much about hedge funds at that point, because they interacted with like the prime brokerage group and more of the traders in our bank. And so it was more of like what I knew and what seemed cool.
I went for very similar reasons. Working on deals, selling companies to sponsors, and at that time at least, like I said, I mean, there's a big difference for those of you who will be joining like very large investment banks. I had a phenomenal experience at mine, and I highly recommend it, especially as an early career. But you work on teams with dozens of people, thousands of bosses, it seems like. And a lot of these firms, I said, are very small, especially with the amount of capital they manage. You'll be shocked to find out that from a JLL had $1.5 billion, there were 12 people there. So that just sounded cool. And then, as in terms of why go to private equity versus hedge fund, in terms of the spectrum of how much oversight you'll have at large banks and consulting firms, you'll have an enormous amount of learning and teaching and oversight. And to the extreme of a very small hedge fund or trading stocks on your own, you'll be completely on your own. And you interview for these jobs a year in advance. I'd only been at Merrill Lynch like 9 months when headhunters started calling. I truly had very little ability to work on my own without direct supervision. So I thought kind of the middle ground, a little bit cooler, a little bit more responsibility, but not like totally cut loose was the place to be.
Yeah. I think you'll get similar answers from all of us. I mean, you're recruiting so early in your kind of career, right? When you're out, that there's advantages and disadvantages to both. I think for me, I saw a lot of these deals. I got to work on a couple. I thought it was neat. It was something I was somewhat familiar with. I think you get one of the advantages